Well, we are positive on the Singapore stock market in 2020. As a backdrop, 2019 was a bit of a challenging year, and we think that some of these challenges will dissipate this year. We are more positive on the economy for 2020, and one of the reasons is that we think that there will be an upturn in the electronic cycle. And that's because the tech companies will begin to rebuild their inventories and produce more, as well as order more capital equipment. In the services sector, we are also seeing an upturn in activity due to diversion of some of this tourism as well as wealth management activity from Hong Kong into Singapore. So for 2020, we see the market doing better because of the stronger economy and stronger corporate earnings growth. And we think that coupled with actually quite attractive valuations, the market will deliver a positive return. Of course. Aside from a stronger economic growth for Singapore, there are two catalysts that I can think of. One of them is that we foresee that there will be stronger fiscal expenditure in 2020. This current term of government in its first 3 years has accumulated almost $19 billion of surplus. So we think that some of that will be spent in 2019, but even more can be spent in 2020. The other catalyst is monetary policy. So the Monetary Authority of Singapore eased their monetary policy in October of 2019, and there's a good correlation between easing by the MAS and an upturn in the equity markets. And we think that the positive effect of the last loosening will be felt in 2020 as well. But we think that we are positive on sectors that represent what we call the new Singapore, or the economy of the future for Singapore. And these would be generally stocks in sectors like tech, data, logistics, healthcare, and tourism. Other than that, we are positive on candidates for corporate restructuring, which we think will gather pace in 2020 as companies look to reinvent themselves in the current environment of recovering growth. Lastly, we continue to like dividend investing. The environment continues to be conducive for dividend investors, and we think that the upgrade in dividend by Singapore companies that we've seen in 2019 will be sustained in 2020. So that will present investors some useful opportunities. Yeah, so one of the key risks is definitely a re-escalation of the trade tensions between the US and China. But we think that's been fairly well discounted into the market valuations. If you look at the PE ratio of the Singapore market, it actually is at an attractive level, and it's quite close to the lows seen in the 2016 economic slowdown, as well as the 2011 Euro crisis. So I think it's fairly well discounted by the markets today.